Welcome back to the deep dive. Today we are tackling a topic that, on the surface, sounds like something kids would do with baseball cards or, lunchbox snacks. It sounds almost trivial.
It really does.
We are talking about the swap.
It's such a deceptively simple name, isn't it? It sounds so casual. I'll swappy this for that.
Yeah.
But in reality, we are talking about what is arguably the most significant financial innovation of the late 20th century.
And I don't think we're exaggerating when we say that. When I was prepping for this, I was just floored by the sheer scale of this market. We aren't talking about millions or even billions.
Oh, no.
We are talking about trillions with a T.
Absolutely. The notional value of the over-the-counter derivatives market, where swaps live, is estimated in the hundreds of trillions. It completely dwarfs the stock market. It dwarfs the global bond market.
It's insane.
It is the invisible plumbing that, keeps the global financial system flowing. It's happening behind the scenes every single day.
And specifically, within that massive number, we're seeing stats that say interest rate swaps account for the vast majority of it. Something like 58, maybe 60% of all over-the-counter derivatives.
That's right. They are the workhorse of the financial world.
So if you are a major corporation, a bank, a government, or even a pension fund, you are swimming in this water whether you realize it or not.
It is the water the financial fish swim in. You really can't run a modern corporate treasury department without understanding swaps. It's just fundamental.
Okay, let's unpack this. How do two massive entities just agree to trade payments, and more importantly, why? So here's the plan for today. We are going to peel back the layers. We want to understand not just what a swap is, the definition, but we want to understand the machinery. We want to get under the hood, look at the math, the valuation, and the underlying strategy.
That's the mission.
By the end of this hour, I want you, our listener, to be able to mentally construct a valuation table and understand exactly how a banker figures out if a deal is worth $1 million or if it's a total disaster.
That is the goal. We want to move from the abstract idea of trading payments to the hard math of discounting future cash flows. We're going from the what to the how much.
But before we break out the imaginary spreadsheets, we have to start with the origin story. Because for something this massive, it's actually incredibly young. It's a child of the 80s.
It is. The swap market as we know it really ignited in 1981.
Yeah.
And it was born out of a crisis.
1981. Now, we have to set the scene here because context is everything. This isn't the economy we know today.
No, not at all. You have to remember what was happening in the late 70s and early 80s. You had Paul Volcker at the Federal Reserve.
The legend.
He was waging an all-out war on inflation.
The famous Volcker shock.
Exactly. Inflation was rampant, double digits, and it was crippling the U.S. economy. So Volcker just jacked up interest rates to crush it. In the United States, interest rates were skyrocketing. I mean, we are talking about 16, 17%, even higher on some government bonds.
Just imagine that for a second. Trying to get a mortgage or a business loan at 17%. It's suffocating.
It was absolutely brutal. But, and this is the key, across the Atlantic, in Europe, specifically in places like Germany and Switzerland, things were different. Their economies were managed differently, their inflation was lower, and so their interest rates were much, much lower.
So you could borrow there for what?
You could borrow in German marks, or Deutschmarks as they were, or Swiss francs for maybe 8 or 10%. Still high by today's standards, but a world of difference.
So you have this massive spread, 17% in the U.S., maybe 10% in Germany. If you're a CFO, you're looking at that German rate and you're drooling.
Precisely. And that brings us to our two main characters in the story, the odd couple of finance. On one side, you have the World Bank,
right?
A massive AAA-rated global development organization. Their whole mission is to lend money to developing nations to build bridges, dams, infrastructure. To do that, they need to borrow huge amounts of capital as cheaply as possible.
So the World Bank sees those low rates in Germany and Switzerland, and they say, we want that.
They did. And they borrowed heavily in those currencies. In fact, they borrowed so much in marks and francs that they effectively saturated the market. The German and Swiss investors were full up. They held too much World Bank paper.
So they couldn't issue any more bonds there?
Not easily. If the World Bank wanted to borrow more, they would have had to pay a premium, a higher interest rate, which defeated the whole purpose of going there in the first place.
They maxed out their credit card in Europe, basically.
In a manner of speaking, yes. They were effectively shut out of the low-rate market they desperately needed. Now, cut to our second character, IBM.
Big Blue.
IBM is a U.S. company, of course.
Yeah.
But they sold computers all over the world. They had huge revenue streams coming in from Europe in Deutschmarks and Swiss francs.
Okay, so they had foreign cash coming in.
Right. But they're shareholders. They're in the U.S. They want their dividends in dollars. IBM had borrowed in marks and francs in the past to kind of hedge those revenues. But in 1981, with the dollar moving wildly, IBM wanted to clean up its balance sheet. They wanted to convert all their liabilities into U.S. dollars.
So let me get this straight. The World Bank wants marks and francs but can't get them easily.
Yep.
IBM has debt in marks and francs, but they want dollar-denominated debt.
You see the perfect storm. It's a classic coincidence of wants.
Yeah.
Two parties with perfectly opposite needs.
So Salomon Brothers enters the chat.
Salomon Brothers, the investment bank, saw this mismatch, and they arranged a marriage. It was brilliant. They had the World Bank issue new bonds in U.S. dollars, a market where they had plenty of room to borrow and got great rates.
Okay.
Meanwhile, IBM held on to its existing German and Swiss debt. They didn't pay it off, and then they swapped.
But they didn't just trade the loans, right? I mean, they didn't just hand the bonds to each other.
No. That would be too expensive. Transaction costs, prepayment penalties, all sorts of headaches. Instead, they kept their original loans with their original lenders, but they agreed to pay each other's bills. The World Bank agreed to make the interest payments on IBM's debt in marks and francs. In exchange, IBM agreed to make the interest payments on the World Bank's new U.S. dollar bonds.
That is the aha moment. They transformed their liability without changing the underlying debt itself. The World Bank got their low-rate German payments, and IBM got their dollar liability. It's genius.
And that deal, the 1981 IBM World Bank swap it, opened the floodgates. It proved that you could unbundle the currency of your debt from the source of your debt, and from there it was a very short hop to the interest rate swap, where you just swap fixed rates for floating rates in the same currency.
Which is where the real volume is today. That's the plain vanilla swap. So let's unpack that. Let's move from history to mechanics. When we say interest rate swap or IRS, what exactly are we trading?
In a plain vanilla IRS, we are trading interest payment obligations on a specific amount of money. One party is the fixed rate payer. They agree to pay a set percentage, say 5%, for the entire life of the deal.
I like certainty. I pay 5%. I know what my bill is every single time. Simple.
The other party is the floating rate payer. They agree to pay a variable rate that moves up and down with the market. Usually this is tied to a benchmark index. For decades, the king of all benchmarks was LIBOR.
The London Interbank Offered Rate.
Exactly.
We should pause on LIBOR for a second. I know there's been a big shift recently, and people might hear other acronyms.
Yes, that's important. LIBOR was, for a long time, the rate at which major global banks lent to each other. But after some scandals and market structural changes post-2008, the world is moving away from it.
Yeah.
Now you hear about risk-free rates like SOFR, the Secured Overnight Financing Rate in the U.S., or OIS, the Overnight Index Swap Rates. These are considered safer and more transparent. However, to understand the mechanics, and if you read any textbook or look at historical data, LIBOR is the language of swaps.
So for our conversation today, it's just easier to stick with LIBOR as the concept for the floating rate.
Exactly. When I say floating rate, just imagine LIBOR. The principle is identical no matter what the benchmark is.
Okay, stick to the classics. So I have a fixed rate mortgage. You have a variable rate mortgage. Let's say I think interest rates are going to drop, so I wish I had your mortgage.
And maybe I'm worried rates are going to skyrocket, so I wish I had the certainty of yours.
So instead of us both going through the hassle and cost of refinancing with our banks, we just shake hands. I agree to pay your variable bill. You agree to pay my fixed bill.
Perfect analogy.
Yeah.
You retain your original relationship with the bank. Your original loan is unchanged. But financially, you have completely swapped your economic exposure. You've synthetically created the liability you wanted.
Now, there's a term that always trips people up, and it's crucial. Notional principle. If we are swapping interest on $100 million, do I actually have to wire you $100 million?
No. And thank goodness, or the banking system would just grind to a halt. In an interest rate swap, the principal is notional. It is imaginary. It's just a reference number we use to do the multiplication.
So it's a shadow number, a ghost number.
Exactly. If the notional is $100 million and the fixed rate is 5%, the payment is $5 million a year. The $100 million never moves. It never changes hands. It just defines the size of the bet.
Okay, let's solidify this with the scenario. Let's use two big companies, Microsoft versus Intel. Let's say Microsoft agrees to be the fixed payer. They'll pay a fixed rate of 5%. on a notional principal of $100 million.
Okay, Microsoft pays fixed.
And Intel agrees to be the floating payer. They will pay whatever the going LIBOR rate is on that same $100 million principal. And let's say the payments happen every 6 months.
Simple enough setup?
Yeah.
Very standard.
Now, talk to me about netting, because if I owe you money and you owe me money at the same time, it seems incredibly silly to have two separate wire transfers crossing in the ether.
It is silly, and more than that, it adds risk. What if I send you my payment and then you go bankrupt before you can send me yours? I'm out the full amount.
Right.
So the market uses netting. On each payment date, we calculate what Microsoft owes, we calculate what Intel owes, and we just look at the difference. Only the difference changes hands.
Okay, let's do the math for the first payment. Notional is $100 million. Fixed rate is 5%. So for a 6-month period, Microsoft's payment is 5% of $100 million is $5 million for the full year.
So you divide that by 2 for the semi-annual payment. Microsoft owes $2.5 million. That's their obligation.
Okay, Microsoft is on the hook for a predictable $2.5 million. That number doesn't change for the whole life of the swap.
Correct. Now look at Intel. They pay LIBOR. Let's say on the reset date for this payment period, 6-month LIBOR is set at 4.2%.
Okay.
So 4.2% of $100 million is $4.2 million per year. Divide that by 2 for the semi-annual payment. And Intel owes $2.1 million.
So Microsoft owes $2.5 million. Intel owes $2.1 million.
Microsoft owes more. So Microsoft simply pays the difference to Intel. $2.5 million minus $2.1 million equals $400,000. Microsoft wires Intel $400,000. Done. One simple payment.
That is so much more efficient. And it protects them, right? Because as you said, if Intel were to go bankrupt, Microsoft hasn't sent them the full $2.1 million. They're only exposed for that net difference.
Exactly. It drastically reduces the credit exposure between the two parties.
Yep.
You are only ever at risk for the net amount, not the gross interest, and certainly absolutely not the principal.
Okay, so that's the mechanism. We agree on the terms, we look at the rates on the payment dates, we swap the difference. But now I want to get into the weeds.
Here's where it gets really interesting.
Because shaking hands is easy, but
Yeah.
valuing that handshake, that's hard. If I am a bank and I have this contract on my books, how do I know what it's worth on any given day? Is it an asset I should be happy about? Is it a liability that's a ticking time bomb?
This is the heart of the matter. This is where we leave the playground and enter the quant desk. Now, an important point. When you first sign a swap, at the very moment of creation, on day 0, the value is almost always 0.
0. Why?
It has to be. The fixed rate is chosen very specifically by the bank, arranging the deal so that the present value of all the fixed payments exactly equals the expected present value of all the floating payments. It's set up to be a perfectly fair trade at the start. Nobody owes anyone anything at second 0.
But then the clock starts ticking. Time passes. The economy changes. The Fed makes an announcement.
And interest rates change.
Yeah.
And that delicate balance is instantly broken. The moment rates move from where they were expected to be, the swap instantly becomes an asset for one party and a liability for the other.
So how do we calculate it? How do we find that new value?
There are 2 main schools of thought here, 2 ways to look at it. Method 1 is to view the swap as a difference between 2 bonds. Think about Microsoft. They have an obligation to pay a fixed rate, and they have a right to receive a floating rate. Mathematically, this is identical to a position where Microsoft has sold a fixed-rate bond, because they're paying out fixed coupons, and used the money from that sale to buy a floating-rate bond, because they're receiving floating coupons.
So the value of the swap would just be the value of the floating bond minus the value of the fixed bond.
Precisely. If you know how to price bonds, you can price a swap.
Yeah.
But there's a more precise way, a way that lets us see all the gears turning inside the machine. Method 2 is viewing the swap as a portfolio of forward rate agreements, or FRAs.
Portfolio of FRAs, that sounds impressive at a cocktail party. What does it mean?
It basically means we stop thinking about the swap as one big thing. Instead, we treat every single future payment date as its own separate mini-deal. We calculate the value of the 6-month payment, then we calculate the value of the 1-year payment, then the 1.5-year payment, and so on. Then we just sum them all up.
Okay, I promised listeners we'd do this. So let's do it. We are going to build the valuation table row by row. I want you to imagine a blank spreadsheet in your mind. Here's the scenario. You, the listener, you are a financial institution. Here's the scenario. You have a swap on your books. Here's the scenario. You are on the side that is receiving a fixed rate of 3%.
Okay, so we're the fixed receiver. We like it when rates go down.
Exactly. And you are paying the floating rate, LIBOR. The notional principal is $100 million. The swap has 1.5 years remaining until it matures, and the payments are every 6 months.
Got it. So we have 3 cash flows left to worry about. One in 6 months, one in a year, and a final one in 1.5 years.
Now, before we crunch a single number, we need to introduce two absolute critical concepts.
Discounting.
Right. The fundamental rule of finance, the time value of money. $1 tomorrow is worth less than $1 today. If I promise to give you $100 in 1 year, you wouldn't pay me $100 for that promise today.
No, because I could just put, say, $95 in the bank today, earn interest, and have $100 in a year. So your promise is only worth $95 to me now.
Exactly. That $95 is the present value. We have to discount all future cash flows back to their value in today's terms using something called a discount factor.
Okay, concept 1, discounting. Concept 2, the forward rate. In our table, we know our income. We are receiving 3% fixed. That's easy. But we don't know what we're going to pay because we don't know what LIBOR will be in a year or in a year and a half. So how do we value the floating side if we don't know the rate?
We consult the oracle. And the oracle in finance is the current market yield curve. The yield curve isn't just a picture of today's interest rates. Embedded within it are the market's collective expectations for what rates will be in the future. We can mathematically derive these implied future rates, and they're called forward rates.
So it's like looking at the betting line for a football game. We don't know the final score, but the betting line tells us what the market's fair expectation is right now. We have to use that expectation to value the bet.
It's the best guess we have. So for valuation purposes, we assume that the future floating rates will be equal to today's forward rates.
Okay, so for this walkthrough, I'm going to give you the forward rates that we've derived from today's yield curve. The first payment in 6 months is based on a rate that was already set 6 months ago. Let's say that was 2.5%. The second payment in 1 year will be based on the forward rate for that period, which is 3.2%. And the third payment in 1.5 years is based on a forward rate of 3.4%.
Okay, and notice the trend there. 2.5%, then 3.2%, and 3.4%. The curve is upward sloping. The market thinks money is going to get more expensive over the next year and a half.
And since we are paying floating, rising rates are bad for us.
Spoilers. But yes, that's the intuition we should have before we even start.
All right, the stage is set. Let's build the spreadsheet. Let's start with row 1. The first payment is in 0.5 years, 6 months.
The fixed cash flow. This is what we receive. It's $100 million times our fixed rate of 3% times half a year.
3% of 100 million is 3 million. Half of that is 1.5 million. So we receive plus $1.5 million.
Easy. Now, column B, the floating cash flow. This is what we pay. The rate for this period was already set at 2.5%. So $100 million times 2.5% times half a year.
2.5% of 100 million is 2.5 million. Half that is 1.25 million. So we pay out negative $1.25 million.
So the net cash flow for this first period, we get 1.5 million, we pay 1.25 million. The net is plus $0.25 million.
Yeah, we're making money on this payment.
Yes, on this one we are. But remember, that money comes in 6 months. We need its present value.
Yeah.
Let's assume the appropriate 6-month discount factor we get from the curve is 0.98.
Okay.
So we take that $250,000 and multiply it by 0.98. The present value is $245,000. So row 1 is worth a positive $245,000 to us today.
A great start. Now let's move to row 2.
1.0, year. The fixed flow. That's the easy part. It's still plus $1.5 million.
Okay.
Always. Now the floating flow. We look at our crystal ball, the forward curve. The 1-year forward rate is 3.2%. So we calculate our expected payment. $100 million times 3.2% times half a year.
That equals negative $1.6 million.
Uh-oh.
Yeah. We receive $1.5 million, but we are expected to pay $1.6 million. The net flow for this period is negative $0.1 million, a loss of $100,000.
And we have to discount that expected loss back 1 full year. The discount factor for 1 year is going to be lower. Let's say it's 0.96. So magnitude $100,000 times 0.96 give us a present value of $96,000. Row 2 is a liability.
The tide is turning. Okay, final payment, row 3.
1.5 years. The fixed flow, reliable as ever, plus $1.5 million.
And the floating flow, we look further out on the forward curve. The rate is now 3.4%. So our expected payment is $100 million times 3.4% times half a year. That is negative $1.7 million.
Ouch. The loss is getting bigger. The net flow here, $1.5 million in, $1.7 million out. That's a negative near $0.2 million.
And we discount that back 1.5 years. The discount factor is even lower now. Let's say it's 0.94. So negative $200,000 times 0.94 gives a present value of negative $188,000.
Okay, we have our 3 pieces of the puzzle. We've calculated the present value of each individual expected cash flow. Row 1 PV plus $245,000 again. Row 2 PV 90 is $96,000 a loss. Row 3 PV. Negative $188,000 a bigger loss. Row 3 PV. Expert, give me the bottom line. What is this swap worth today?
We just sum them up. The total value of the swap is the sum of the present values of its parts. So 245,000 minus 96,000 minus 188,000 equals negative $39,000.
So despite that nice first payment where we made $250,000, this swap is a liability on our books.
It is. If you wanted to exit this deal today, you couldn't just walk away. You would have to pay someone, another bank, roughly $39,000 to take over your position.
And why? What's the narrative here? Why did it end up negative?
The narrative is that you are long the fixed rate and short the floating rate. You made a bet that interest rates would stay low. But the market, speaking through the forward curve, is now predicting that rates will rise above your 3% fixed rate in the future. The expected future losses are bigger than your known near-term gain.
That is so clear when you break it down row by row. It's not just some black box number the computer spits out. It's a sum of specific, tangible expectations about the future.
Exactly. And you can see how sensitive it is. If the Fed chairman gives a dovish speech tomorrow and the market suddenly thinks rate hikes are off the table, what happens?
Those forward rates in row 2 and row 3 would drop?
Right. They might drop to, say, 2.8%. Your floating outflows would shrink. The net flows for those periods would flip from negative to positive, and suddenly your negative $39,000 swap could be worth plus $500,000, just like that.
So volatility is the engine of value here. The value is constantly changing as the market's expectations change. But this brings me to the biggest question, the why. We just did a lot of math to show that after day 0, this is a zero-sum game. One side's gain is the other side's loss. If I'm a company, why bother with all this? If I want a fixed-rate loan, why don't I just go to the bank and ask for a fixed-rate loan? Why go through this complicated dance of borrowing floating and then swapping it to fixed?
That is the multi-trillion-dollar question. And the answer, or at least the textbook answer, leads us to one of the most elegant and frankly debated concepts in finance, comparative advantage.
I remember comparative advantage from my Econ 101 class. Portugal is great at making wine. England is great at making cloth. So Portugal should just make wine, England should just make cloth, and then they trade. Everyone gets more of both.
It's the exact same principle, but instead of wine and cloth, we are trading access to different credit markets. Let's set up another scenario. We have two companies.
This is the golden child. A huge, safe, blue-chip company. Think Johnson & Johnson or Microsoft.
A bit riskier. Still investment grade, but maybe they have higher leverage or their earnings are more volatile.
Okay. And let's say both of them need to borrow $100 million for 5 years. Here's the twist. AAA Corp wants a floating rate loan. Maybe they think rates will fall. Here's the twist. BBB Corp wants a fixed rate loan. They want certainty.
Now, obviously, AAA Corp is going to get better rates than BBB in both markets because they are a safer credit. Lenders will always charge them less. Let's look at the actual rates they are offered by the banking system. For AAA Corp, they can borrow fixed at 4.0%, or they can borrow floating at LIBOR 0.1%.
So they get a discount to LIBOR. They're that good.
Exactly. Now, for BBB Corp, they can borrow fixed at 5.2%. Or they could borrow floating at LIBOR plus 0.6%.
Okay, now let's look at the spread, the penalty for being the riskier BBB Corp. In the fixed rate market, the difference is 5.2% minus 4.0%. The penalty is 1.2%.
Right, 120 basis points.
But in the floating rate market, the difference is LIBOR plus 0.6% minus LIBOR 0.1%. The LIBORs cancel out. The penalty is only 0.7%.
Stop right there. That is the magic. That is the anomaly that gives birth to the entire interest rate swap market. Why is the penalty for being risky 1.2% in the fixed rate market, but only 0.7% in the floating rate market? Why does the credit spread change depending on the type of loan?
Yeah, that is weird. If BBB is risky, they're risky. It shouldn't matter if the loan is fixed or floating. Why do fixed-rate lenders seem to hate them so much more than floating-rate lenders?
This is saw paradox. The general theory is that long-term fixed-rate lenders charge a massive fear premium for dealing with lower-quality credits. If I'm a bond investor and I lend money to BBB Corp at a fixed rate for 5 or 10 years, I am stuck with them. If their credit quality drops, I can't raise the rate on them. I'm locked in.
You're exposed.
Totally exposed. So to compensate for that risk, I charge them a huge premium up front, just in case things go bad.
But with a floating rate loan?
With a floating rate loan, it's different. Often the loan is from a bank that has a closer relationship with the company. The rate resets every 6 months. The bank feels like it has more control. It's not locked in for a decade. So they don't punish BBB quite as hard on the spread.
So, to use the Econ 101 term, BBB has a comparative advantage in the floating market. They are less bad there. And AAA Core has a comparative advantage in the fixed market. They are super strong there. The penalty for BBB is highest there.
You've got it. So the strategy is simple. Each company should borrow in the market where it has a comparative advantage, regardless of what it actually wants. Play to your strength.
So AAA Core should borrow fixed at 4.0%, even though they want floating.
Yes. And GBB Corp should borrow floating at LIBOR plus 0.6%, even though they desperately want fixed.
And then they find each other. The bank is an intermediary and they swap.
Let's trace the money, because this is where the magic happens. So AAA borrows fixed at 4.0%. BBB borrows floating at LIBOR plus 0.6%. Then they enter a swap. Let's say the bank arranges a swap where AAA agrees to pay LIBOR to BBB. In return, BBB agrees to pay a fixed rate of, say, 4.35% to AAA.
Okay, let's verify the math. Let's look at it from AAA Core's perspective. They have three cash flows. 1, they pay 4.0% to their bondholders. That's an outflow. 2, they pay LIBOR to BBB as part of the swap. That's another outflow. 3, but they receive 4.35% from BBB. That's an inflow. So their net cost is 4.0% plus LIBOR 4.35%. That simplifies to LIBOR 0.35%.
And what was the original offer they got from the bank for a floating rate loan?
It was LIBOR 0.1%. Wait a minute. They just ended up with a floating rate loan at LIBOR minus 0.35%. They beat the bank's original offer by 0.25%.
A huge saving. 0.25% on $100 million is a lot of money. Now look at it from BBB Corp's side. 1, they pay LIBOR plus 0.6% to their bank. That's an outflow. 2, they pay 4.35% to AAA, another outflow. 3, they receive LIBOR from AAA, an inflow. The two LIBOR payments cancel each other out.
Right. The LIBOR they receive from AAA pays for the LIBOR part of their bank loan.
So their total net cost is just 4.35% plus the 0.6% spread. That's a final all-in fixed rate of 4.95%.
And their original fixed offer from the bond market was 5.2%. So 5.2% minus 4.95%, they saved 0.25% too.
Everyone wins. AAA gets a cheaper floating rate. BBB gets a cheaper fixed rate. The total surplus created out of thin air is 0.5%.
Hold on, I have to play devil's advocate here. I'm listening to this and I'm thinking, this sounds like a perpetual motion machine or some kind of financial Ponzi scheme. If AAA Corp and BBB Corp are both saving money, who is losing? Is the bond market stupid? Is the market just inefficient? This can't be a free lunch.
That is the crucial, critical question. Is it a free lunch? Now, many economists will argue that, yes, the swap market is just a form of arbitrage. It's exploiting and correcting the inefficiency of that fear premium we talked about. It's making the market more perfect. BUT, there is a darker interpretation.
Which is?
When AAA Corp enters into this swap, they are now relying on BBB Corp to make those 4.35% fixed payments for the next 5 years. What happens if, in year 3, BBB goes bankrupt?
Then those payments stop coming, and AAA is suddenly stuck paying their original 4.0% fixed loan, which they never wanted in the first place. They've lost their hedge.
So AAA Corp has taken on the credit risk of BBB Corp. That's a risk they didn't have before.
Ah.
So is that 0.25% saving a profit? Or is it just the fee AAA receives for implicitly selling credit insurance on BBB? Are they outsmarting the market, or are they just underpricing the risk of a BBB default?
That is a much more unsettling way to look at it. It suggests the savings might just be a trap waiting to spring if things go wrong.
Welcome to financial engineering. Nothing is ever truly free.
All right, we have dived deep into interest rate swaps, but we started the whole show talking about IBM and the World Bank with Deutschmarks and US dollars. We need to talk about currency swaps. How is this different from what we just spent all this time discussing?
The math of the interest payments is actually quite similar. You're swapping a fixed rate in one currency for a fixed rate in another, or maybe a fixed for a floating. But there's one massive structural difference that changes everything. In the interest rate swap, we hammered home the point that the principal was notional. It's a ghost. It never moves.
Right.
In a currency swap, the principal is exchanged.
Physically moved, wired from one bank account to another.
Yes. At the beginning of the deal, there's a physical exchange of principal amounts, and at the end of the deal, there is another physical exchange to swap it back.
Why? Why the extra step?
Because remember the original story. IBM didn't just want to hedge against currency movements. They needed actual dollars for their business. The World Bank needed actual marks and francs to lend out. The parties often have a genuine need for the foreign currency for their operations or investments.
That sounds way more dangerous.
It is. Infinitely more dangerous. Imagine the timeline of a fixed-for-fixed currency swap.
I am a U.S. company, you are a UK company. We agree to swap. I physically give you $15 million. You physically give me $10 million. The exchange rate is $1.5 to the pound.
Okay, we've traded cash.
During the life of the swap, we swap the interest payments. I pay you interest in pounds on the 10 million pounds I'm holding. You pay me interest in dollars on the $15 million you're holding. End of the swap. This is the critical part. We swap the principal back at the original exchange rate.
Wait, you swap it back at the original rate? Even if the market exchange rate has changed dramatically over the 5 years?
Yes, that's the entire point. It locks in the exchange rate for the principal repayment. It eliminates that specific risk. But think about the other risk it creates. Suppose 5 years pass and the dollar has collapsed against the pound. The exchange rate is now 2.5. That 10 million pounds I'm holding from you, it's now worth $25 million on the open market.
Wow.
But our contract says I have to give it back to you, and all I get in return is my original $15 million. I've missed out on a huge currency gain.
Okay, but what if you default? If you go broke on the last day, I never get my $10 million back. I am stuck holding $15 million, but that's what I started with. Let's flip it. Suppose the pound crashes. It goes to 1-to-1 with the dollar. The 10 million pounds I'm holding is now only worth $10 million. And on the last day, you default. You don't give me back my original $15 million.
Exactly. I'm left holding a bag of pounds that are only worth $10 million, and I'm out $5 million of principal. In a currency swap, you are exposed to the full value of the principal. If the counterparty defaults and the currency is moved against you, you can lose a massive chunk of the loan value.
So the credit risk profile is completely fundamentally different.
It is.
Yeah.
In an interest rate swap, if the other guy defaults, you might lose a little bit of net interest difference. It's an inconvenience. In a currency swap, you can lose the whole enchilada.
And that must make valuing a currency swap much harder too, right?
Much harder, because now your valuation depends on two different interest rate curves, one for the US, one for the UK, and the volatile spot exchange rate bouncing around every second. The basic formula is something like value of the dollar bond minus the spot exchange rate times the value of the foreign bond. The basic formula is something like, it's like balancing a plate on a stick while riding a unicycle. There are a lot of moving parts.
It's amazing. We group them both under the single word swaps, but one is a relatively safe netted instrument focused only on interest, and the other is a high-stakes, full principal exchange.
Which is why banks demand much higher collateral and have much stricter credit checks for currency swaps. The potential loss is just so much greater.
We're coming up on time, but I want to zoom out for a second. We've talked about plain vanilla interest rate swaps. We've talked about currency swaps. But this is really just the tip of the iceberg, isn't it? This market gets a lot more creative.
Oh, it's a whole ecosystem, a financial Lego set. You have credit default swaps, CDS, where you aren't swapping interest at all. You are swapping the risk of a company or a country going bankrupt. One party pays a regular premium like an insurance payment. The other party promises to pay out a huge sum if the reference entity defaults.
That was the instrument at the heart of the 2008 crisis with AIG, right? They sold way too much of this insurance.
Exactly. Then you have things like equity swaps. Imagine you want exposure to the stock market, but you don't want to actually buy all 500 stocks in the S&P 500. We could enter a swap where I agree to pay you a fixed interest rate, and in return, you agree to pay me the total return of the S&P 500 index.
So that effectively allows me to synthetically own the stock market without buying a single share.
Precisely. The core idea is always the same: unbundling. Finance used to be a package deal. If you made a loan, you took on the interest rate risk, the currency risk, and the credit risk all bundled together. Derivatives and swaps in particular allow you to chop that bundle of risk into little sticks. You can say, okay, I'll keep the credit risk, but I'll swap the interest rate risk to you, and I'll swap the currency risk to him. You can customize your risk exposure with incredible precision.
It's financial alchemy, turning the liability you have into the asset profile you want. So let's just quickly recap the journey we took today. 1. Origin. It started with the Volcker shock and the unique opposite needs of IBM and the World Bank. 2. Mechanics. It's an agreement to pay each other's bills. And that critical term, notional principal, means the big money doesn't move, at least in an interest rate swap. 3. Valuation. We built a table. We saw how you use forward rates to forecast the floating payments and then discount everything back to today to find the swap's value. 4. The why. The concept of comparative advantage. It's either an arbitrage of market inefficiency or a clever way of transferring risk. 5. Risk. And finally, that currency swaps are the dangerous cousins of the family because they involve a full exchange of principal at the beginning and the end.
A perfect summary of the landscape.
It really changes how you look at a bank's balance sheet, doesn't it?
Yeah.
You realize that what's printed on the page, loan at 5% fixed, might be a complete fiction. They might have swapped that into a floating rate in Japanese yen 5 minutes after they wrote the loan.
The balance sheet is just the cover of the book, the derivatives profile, the swaps on the books. That's the real story inside.
I know you like to leave us with a provocative thought, something for our listeners to chew on. What have you got for us today?
Well, we touched on it when we discussed the swap paradox. We live in a world where trillions of dollars of financial instruments exist because of these tiny spread differentials, that 0.5% gain that was created between AAA and BBB Corp. My question is this. As our financial markets get more and more efficient, as pricing gets faster, as algorithms and AI take over, should that spread differential exist at all? Is the swap market a permanent feature of finance? Or is it just a temporary 40-year-old patch for an inefficient banking system that, for historical reasons, treats fixed and floating loans to risky companies differently? Are we building this colossal castle on a foundation of fear premiums that might one day, with better data and better risk models, just disappear? And if it does, what happens to the cast?
That is a deep thought. If the underlying inefficiency goes away, does the multi-trillion-dollar swap market just vanish? Or at least shrink dramatically? We will let you ponder that one. Thank you for taking this deep dive with us.
It was a pleasure, as always.
We'll see you in the next one.